Hi, I'm Bill Blain, strategist with Shard Capital here in London. Now please forgive a humble Scotsman from giving America a talking to, but we really do need to talk about your economy. At the moment, US labour market is tighter than it's ever been before. Inflation is extremely low. We've seen 10 years of solid growth. Yet last night we heard Jerome Powell, head of the Federal Reserve, telling investors that he was ready to ease rates if trade tensions escalate. What is going on? The last thing the US economy really needs is rates to be eased at this point. Saying that he will ease rates because of the trade tensions is like giving an open check to markets. Because it's not as if lower interest rates actually help the economy. We have 10 years of experience that now shows us exactly what happens when interest rates are lowered to unfeasibly low levels. What happens, you ask? Well, corporates go out and binge on debt. Effectively, they replace their equity by over-leveraging themselves to borrow money on the bond markets, which they then spend on stock buybacks. Now that pushes up the value of the stock. As a result, the rest of investors see, oh, that stock's going up, I better buy it. As a result, buybacks give the impression that the stock is worth more. But remember, by borrowing all that money, the company has not added a single productive asset or created a single new job to boost its profits. All it's done is push up your share price, which usually results in a bigger bonus to executives or to the private equity owners receiving a larger dividend. So stock buybacks don't really help, but they certainly leverage up the company. Then you have the effects on the whole economy of interest rates being very low. It means that zombie companies, those are the ones that are already heavily indebted and have run out of the managerial skills to keep their company going, continue. We lose that important Darwinian selection that so characterizes markets, where firms rise and fall and the bad ones get replaced by new, nimbler ones that can do a better job in the market niche or even invent whole new market niches, as we've seen with the tech sector. So long term, low interest rates are not proven to help the economy. Now it might sound like tremendous sense to enable the US to fight a trade war with China by reducing interest rates to the lowest possible level. But I would urge Chairman Powell and the rest of the Fed not to mistake stock markets for economic growth. If stock markets fall, that's because the perceptions of the future values of stocks are declining. But if we're right about this trade war, the opportunity for the US to build and redefine its economy should be enormous. We could see the introduction of new manufacturing in the US from areas like 3D printing and robotics. It doesn't necessarily need to destroy jobs. We could see a complete redefinition of the whole US economy if we had a proper infrastructure package in place that would benefit alongside proper interest rates. Proper interest rates are the kind of levels where companies are encouraged not to buy back their own stocks or purely financial asset trades, but to actually do capital expenditure, building factories, building plants, and creating real jobs. So I would urge the Federal Reserve to step back, acknowledge that it is not about stock markets, it's about the real economy.